This is Matthew Cratter from Trade University, and today I want to talk about the Fed emergency meeting that is scheduled for tomorrow. But before I do that, I want to talk about where we are. Many of you have been asking for a general global macro update. So we have to return to what happened in the UK last Wednesday. UK pension fund managers, over the years, they've needed to return something like 10%. The problem is that interest rates have been so low for so long. UK bonds were really only able to offer about 2% yields. So what they did is they levered them up 5x using borrowed money. And this means that when bonds fall 10% in price because they're levered up 5x, UK pension managers lose 50%. So I'm making up these numbers. We don't know exactly what happened, but we do know that as of last Wednesday, UK pension funds were essentially insolvent and could not meet margin calls. And this is why the Bank of England needed to step in. So these pension funds say, help, we need a bailout. And it was at that point last Wednesday that the Bank of England, also the BOE, called the BOE, pivoted and stopped selling bonds and started buying bonds, which are called gilts in the UK, in order to prevent the entire UK pension system from imploding. And the really interesting thing about this that we pointed out is that the Bank of England has actually gone back to printing money again when inflation is at close to 10%. I thought they were supposed to wait until inflation came back down before pivoting. This was the bluff that all central banks have been saying, but it looks like this is not going to be possible because things are decelerating and crashing so quickly. I like Mike Tyson's quote, everyone has a plan until they get punched in the face. The Bank of England was talking a really tough game, but when it came time for their entire pension system to blow up, of course they pivoted and reversed course. This is also a pretty good meme with Do Kwon as head of the new head of monetary policy at the Bank of England. Also this one, I don't mean to make light of a dire situation, and certainly there are a lot of countries who are in trouble now. But I think humor is one way of dealing with this. Has anyone tried switching Britain off and on again? So what we saw happen with the UK pension system last week, this is the kind of thing I was talking about when I said that the Fed and other central banks would keep hiking and tightening until something broke. And now more and more things are breaking. There are a lot of rumors on Twitter that there's a major international investment bank on the brink, most likely Deutsche Bank or Credit Suisse, which Deutsche Bank has been in the process of imploding really since 2008, 2009, and has never really recovered that much. Credit Suisse also having problems, credit default swaps on both of these companies going through the roof, and this may be what is happening. The other thing that's happening is, and I forgot to cover this last week, Australia's central bank, so their equivalent of the Federal Reserve, was basically bankrupted by bond losses. This is an unbelievable headline and article, and I think we should try to save this somewhere. This is from Reuters. Australia's central bank has equity wiped out by billions in bond losses. Australia's central bank on Wednesday said its equity had been wiped out. In other words, the bank is bankrupt by losses suffered on pandemic-era bond buying. So they bought a lot of bonds. Now these bonds have crashed because they've stopped buying, and as a result, they have more debt than they have assets. They have more liabilities than they have assets. But here's the punchline and the great one. But its ability to create money meant it was not insolvent and would continue as normal. This is what we're dealing with central banks. We're dealing with funny money, and we're dealing with rules that don't apply to anyone else. I like this analogy here from Monopoly. The bank never goes broke. If the bank runs out of money, the banker may issue as much more as needed by writing on any ordinary paper. And this is what central bankers do these days. So this is the context: Credit Suisse blowing up, Deutsche Bank blowing up, the Australian central bank blowing up. This is the context in which this emergency Fed meeting is coming tomorrow on October 3rd. It's a closed board meeting, and it's being governed under the Sunshine Meeting regulations. The Sunshine Act basically says that the U.S. government and various parts of it can hold closed-door meetings if disclosing information about what's happening in those meetings would do any of these things. If it would, here's the one it's probably applying to, it would likely lead to significant financial speculation, significantly endanger a financial institution's stability. something like that. So that's why this is going on behind closed doors, but they're almost certainly talking about Credit Suisse or Deutsche Bank or some large hedge fund or something that we don't even know about yet. So the Fed is still technically engaged in QT, also known as quantitative tightening, which just means that they're trying to shrink their balance sheet by letting treasuries and mortgage-backed securities mature and not buying new ones to replace them. So this is the problem. We've been talking about this, but the Fed is essentially a net seller of treasuries for this reason, because they've ceased being the largest buyer out there. The U.S. Treasury is also going to be a large seller of treasuries. Instead of selling treasuries on their balance sheet, though, they'll be selling new treasuries in order to raise money for the U.S. federal government. As tax receipts plummet, we have this budget deficit of almost $1 trillion. And as this recession continues, this budget deficit could explode to $2.5 trillion. And that is the difference that's going to need to be made up by issuing government bonds called treasuries. So we have the U.S. Treasury continuing to have to sell new bonds. The Fed is selling. Also, all the foreign central banks, the Chinese central bank, the Bank of Japan, the Bank of England, and the European Central Bank, the ECB, these all need to dump U.S. treasuries to raise dollars to defend their currencies from the strengthening U.S. dollar. Now, that's a lot of treasury selling, and that's a lot of new supply that the market needs to be able to absorb. And the problem with this is when you have a lot of treasury selling, prices going down, that means yields going up, which means U.S. interest rates going up, especially from 5 years to the 30-year maturities on these treasury bonds. Higher interest rates will continue to wreck the stock market, kill the housing market, cause tax revenues to plummet because no one's making any money in the stock market or housing market this year, which means that the U.S. Treasury, because of falling tax revenues, will need to sell even more bonds to make up the difference. The other problem with higher U.S. interest rates is they also help to keep the U.S. dollar strengthening, which means that other countries need to sell even more treasuries to defend their currency. So we have sort of a doom loop going on right now. There was a note from Bullard on the Fed, on the FOMC, saying that they may need some time to assess the impact of their balance sheet runoff. This is a suggestion that perhaps they are going to pause quantitative tightening. Problem with a strengthening U.S. dollar is it makes energy more expensive for everyone who needs to get their hands on U.S. dollars to trade them for crude oil or natural gas. This is especially a problem for China, Japan, and countries in Europe that took their energy policy from a Swedish high schooler. I thought this was a pretty good meme. Investigators have concluded that the Nord Stream pipeline committed suicide after the guards fell asleep and security cameras stopped working. If you don't already follow World E-Communist Forum, they are pretty funny. So the global financial system is extremely fragile right now, and the central banks have been trying to hold things together for the past few years. But the Fed tightening that has occurred has caused so many fires at this point and so many things to blow up. The wheels are starting to come off that really anything could happen in the coming weeks. And I want to say this very explicitly. I've said it in other places. I was definitely wrong about stocks not hitting new lows. We saw new lows on stocks last week. So that's definitely something that I got wrong. So far, I'm still right about Bitcoin having bottomed in June, and Bitcoin is showing very good relative strength compared to stocks and other risk assets. This is something that's been very striking. It's only been happening the past week or so we don't want to place too much of an emphasis on it, but it is a good sign. And it may be a sign that Bitcoin is looking ahead and beginning to price in a Fed pause or pivot that is coming. This is how markets work. This is especially how Bitcoin works. It's a very forward-looking market. It started to run up even before inflation took off, and then it started to crash even before inflation started to come down and the Fed began to get aggressive. The other thing we have going for us is this positive seasonality. September, as we've seen, and this was a bad September, just like the September of 2008 and the September of 1998. September is usually the weakest month of the year for the markets, for the stock market in particular. And then usually, at least the seasonal effect is we see a large recovery in the fourth quarter. At this point, though, it's really going to be up to the central bankers whether we get a nice reversal. We've said that Putin and Biden have nukes, and everyone knows this, but it's really Jerome Powell who has the financial nukes. And we also shouldn't ignore the regular nukes. There's some very disturbing stuff coming out of Russian media, And this is one problem. If Putin does get backed in a corner, we could see desperate moves, and hopefully we don't have to see a thermonuclear war in our lifetimes. Here's the basic problem, though. Here's the basic underlying financial problem. The Fed tried to raise rates aggressively. They said basically that there was no problem, inflation was transitory. They got this very wrong, and there was egg on their face. And so they decided to try to rehabilitate their public image and really come out aggressively against inflation, which would make sense in any other environment. It made sense in the 1970s when debt to GDP levels were much lower. The problem is today debt levels are at their highest in 80 years. I've showed this chart many times. If you want to be a Paul Volcker, it's much easier to do it. Back here in the 70s and early 80s, when debt to GDP was at something like 31%, it's now at 121%. And it's come off a bit from the highs as we've begun to inflate our way out with the high inflation of the last few years. But in order for the Fed to raise rates without really blowing things up, you need to get inflation at least back down here to 60. You need to get debt to GDP down to something like 60%, maybe 70%. Basically take out everything that's happened since 2010, and then you'd be able to normalize interest rate policy and raise interest rates without things blowing up as much as they are. If the Fed stays this aggressive, things are going to continue to blow up. It's going to get worse and worse and worse. At some point, though, the Fed will cry uncle. They'll turn back on the money printers, even with inflation still high. And this is the important thing. Of course, if the Fed engineers a complete depression, then we don't have to worry about inflation being high, and they can declare a sort of Pyrrhic victory of sorts. So I'm still dollar cost averaging into Bitcoin. I put in some limit orders down at 17,500 and 15,000 in case we see a quick spike down overnight, for example, while I'm sleeping. It's important to remember in this environment, please avoid leverage, avoid trading if you can, avoid trading anything from the long side or short side, because we have the possibility to see very large crashes down, but also very large up moves. And so this is the kind of environment where people get wiped out if they try to get too fancy. Literally anything could happen in the coming weeks. Obviously, the Fed is already getting quite worried if they're calling an emergency meeting for tomorrow, and we'll be covering what comes out of that meeting. Again, I want to point out this was the video in which I said the bear market was over. I definitely got this one wrong, while many of you are actually quite right in the comments. And for once, I am guilty of being too bullish. I'm always accused of being too bearish, but in this case, never in my wildest nightmares did I think that the Fed would take things this far. I assumed that they were just bluffing and that they actually knew that raising rates this quickly, this aggressively from such a low level, basically going from 0 to 3 or 4%, would blow things up globally. And I assumed that they would stop before things got this bad, especially if they saw inflation beginning to tick down as we saw at the end of July, which is why I made this video, because it looked like the economic numbers were going our way, and that the Fed would be able to declare victory even though they hadn't completely defeated inflation, but they would be able to sort of salvage the situation and say we did what we could. I assumed that they would stop before things got this bad, but I was definitely wrong about that. So here at the beginning of October, we're in a situation where the Fed has only one choice now, and they should do it on Monday. They need to turn back on the money printers. And I'm not just saying this because I own Bitcoin, etc. I'm saying this is actually how economies get out of huge debt loads. They need to turn back on the money printers and start buying bonds again. The only way out of this mess is to inflate. You can't get rid of the high debt by causing huge amounts of deflation or causing a recession or a depression. If we go into a deep depression with these debt levels, things are going to be really, really, really bad. And I hope that we don't get to that point. I hope the Fed comes to their senses, as it appears to be Bullard is, and they start growing their balance sheet again. Because there's no way you can try austerity, you can try cutting government spending. That's just not going to work, especially going into midterms. And so the only real way out to avoid an outright default is to do sort of an implicit default, devalue the currency by printing a lot of it, and inflate our ways out of this mess. And again, it's not just the US that's at these very high debt to GDP levels, but it's most countries around the world. Ironically, Russia has one of the lowest debt to GDP levels, which I think is a great irony. But the only way out of this mess is to inflate. And the sooner they get around to it, the better. They could declare a Pyrrhic victory on Monday, turn the money printers back on, and get us out of this mess whenever they want to. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.